I think once we get through this next rate hike or two, I think you're going to see a pretty explosive precious metals market. I think by the end of 2020, April of 2024, we're going to see gold somewhere around 2,500. So more than 20% higher than where we're sitting at now. A year from then, April of 2025, we're looking at probably 5,000 gold. I think going into the end of 2024, it's going to be absolute chaos here in the United States. You have the presidential election. It's probably going to come down to a couple of votes. It's going to be another one of these 50, 49, 51, 49% deals. You're going to have people. I think if Trump wins, you're going to have chaos. If Trump loses, you're going to have chaos. And all those things are going to be good for the gold market. That's just going to push people to, sound money.
Thomas Parilla, the president of Parilla Investment Group, says the precious metals market is ready for a massive price explosion, which will take gold to around $2,500 by April 2024 and $5,000 the following year. Parilla's bullish predictions for gold, silver, and other safe haven assets are primarily based on the very shaky state of the economy of the United States. According to the renowned analyst and investor, the U.S. Federal Reserve is currently in a very difficult situation, caught between the rock of keeping inflation down and the hard place of servicing the government's massive $33 trillion debt in such a high interest rate environment. Earlier in the week, total U.S. federal debt crossed $33 trillion for the first time in history, a $1 trillion increase in only 3 months. On September 19th, the Kobayashi Letter, a popular newsletter that provides detailed analysis on the global capital markets, announced the news via its official Twitter account. Breaking, for the first time in history, total U.S. federal debt crosses $33 trillion. The post notes, adding that, since the debt ceiling crisis, the U.S. has added $1 trillion in debt per month. Over the last 5 years, the U.S. has added a total of $11.5 trillion in debt. At the same time, we are on track for $1 trillion in annual interest expense. Less than 3 days after the first post, the newsletter dropped another debt bombshell in a follow-up post which reads, "It has been 60 hours since U.S. debt crossed $33 trillion, and it is already up another $50 billion. That means we have added $833 million in debt per hour since U.S. debt crossed $33 trillion. If the total U.S. debt were divided by every household in the country, each household would get $252,000. We are officially paying more than $2 billion per day in interest expense, all while the debt ceiling bill leaves the debt limit uncapped until January 2025. Something needs to change." It further noted that the Congressional Budget Office previously predicted that total U.S. debt will hit $50 trillion by 2030. If we are accumulating almost $1 billion in debt per hour in such a high interest rate environment, it is safe to estimate that we will hit that huge debt threshold much sooner than the CBO projects. We will now bring you clips from Parilla's recent interview with Wall Street Silver. Please watch the video to the end, subscribe to the channel if you are yet to do so, and don't forget to smash the like button. Thanks, and enjoy the video.
They're still walking that tightrope, and they've been doing it for months, and so far successfully. I think they telegraphed one more rate hike is coming for sure in November, but there could be a second one. So I think the gold silver markets, we might be trapped in a little bit of a range still as we wait for the Fed to finally pause. But I think we're getting to the point where you're about 90% through. So maybe one more rate hike, maybe two. I think it's going to depend on the economy. If the economy starts to show signs of like really cracking, then the Fed's going to be trapped where they can't raise. They might want to raise another time or two, but they won't be able to. The banking system is hanging on by a thread, but the Fed has been pretty sneaky and successful about what they've done. They're doing a bailout program right now. There's no doubt about it. It's a bank bailout in process. What they're doing is they're giving that emergency window open for the banks, and the banks are shifting their bonds that they're way underwater on over to the Fed. And of course, then the Fed just prints dollars to buy them, so it's a taxpayer bailout. But they don't want to use the term bailout because that has such a bad connotation, years ago.
Right.
But there's no doubt about it. They're bailing them out, and I don't think they can continue to do that forever. The banks are still struggling really bad, and right now it's because of the treasuries. But I think the next shoe to fall, that commercial real estate market is just a disaster right now. Properties are going up on the market for 50, 60% discount from where they were. Somebody's going to eat that. It's going to be the bank. than the taxpayer. They'd have absolutely no choice. They'd have to inject liquidity immediately.
Right.
So they'd begin that probably pretty aggressively at the beginning. They'd have no choice. And the problem you've got then from an economic point of view, then the dollar tanks at the same time, because the only thing holding the dollar up right now is, one, all the other fiat currencies in the world have collapsed.
Right.
Leaves us as the last one standing. But the other part about it is you run into a problem where if the Fed hikes go away, that's the only support for the dollar. So then the dollar rolls over. If the dollar rolls over, now you've got oil already at 90. A lower dollar, you're going to have oil at 120, 130.
Mm-hmm.
So all of a sudden, the Fed will try to inject liquidity on their own, but at the same time, there's other parts of the economy that are going to be pulling that liquidity back out. The inflation you talked about, I don't think they understand how bad discretionary income is out there in the country right now.
Right.
People have gotten squeezed tighter and tighter. That works for a while, but if any little problem pops up in the meantime, all of a sudden it turns into a big deal. I think going into the end of 2024, it's going to be absolute chaos here in the United States.
Mm-hmm.
You got the presidential election. It's probably going to come down to a couple of votes. It's going to be another one of these 50, 49, 51, 49% deals. You're going to have people, I think if Trump wins, you're going to have chaos. If Trump loses, you're going to have chaos. And all those things are going to be good for the gold market. That's just going to push people to, sound money. And at the same time, you're going to have the Federal Reserve sitting there, trying to fight inflation with one hand, but also trying to pump liquidity into the market with the other hand.
Mm-hmm.
So they're on a serious tightrope. I've been looking at some of the numbers. Some of these numbers are staggering. Right now, the U.S. debt, of course, this week broke $33 trillion in debt.
33, yeah.
But the important number is we're now 122% debt to GDP. Now, if you go through your old economics books, anytime debt to GDP rises above 90%, it typically slows your economic growth by 30%. So, if you're growing your economy at 3%, it really, without the debt, it's probably a 4% economy. But the debt's such a lag on it. Right now, 35% of all tax revenue coming in for the United States goes to pay the debt, the interest on the debt.
How much is that? What percentage?
35%.
35% of tax revenues is going toward paying debt expenses. Meanwhile, $7.5 trillion of the total debt will mature next year, which means new bonds will be issued. More debt will also be issued to cover a projected $2 trillion in deficit next year. So, a total of $9.6 trillion in debt will be issued, adding at least another $400 billion in debt servicing expenses. In a matter of months, the U.S. will be paying as much as $1.4 trillion to service its massive debt expenses. This presents various levels of difficulties for the economy. First, who is going to buy almost $10 trillion in U.S. debt next year? And if yields are further hiked to make our debt securities more attractive, the Fed will be wielding a double-edged sword, one edge destroying the banking and real estate industries, and the other edge pumping the interest yields back into the economy, which means high prices and sticky inflation. Prices are already picking up sharply. Live cattle just closed at their highest price on record, up approximately 20% in 2023. Olive oil prices are up by 100%, and orange juice prices have risen by 70%. All as oil prices are back above $90 and gas prices are approaching $4. Inflation on many basic necessities is still well above 5%. Let's get back to the interview as Parilla discusses the possibility of a massive dollar index correction and what that will mean for gold and other precious metals.
And the thing is, when you look at what's going on with our debt right now, the way we're tacking on a couple of trillion every couple of months, that 35% could grow to 50% pretty easily, because the problem you've got right now also is a lot of the debt is going to mature, and we are paying very low interest rates on that debt. Now you roll it out. It's almost setting up a bond ladder. If you had a 10-year bond ladder, you get a small rate of return on the 1 year, but you get a nice return on the 10. And then what happens is when the 1 year matures, you just roll it out to the farthest end of the ladder.
Right.
And that's what the Fed does. But the problem is they've got all these bonds now maturing that we're paying, we're very low interest rates. So cheap for the United States. I think the average cost was like 2.7%. But now they're going to have to re-up that. So if you're paying 2.7 and all of a sudden you turn around and maybe you're paying 3.7, over the next 3 to 6 months, you're going to see a huge amount of treasuries come due.
Interesting.
That's all got to get rolled back in. And if you look at the 10-year note, it's been hanging around 3.4% or somewhere in that area. I think there's a pretty good chance if this debt all starts rolling in, just look at the supply demand, the prices of the bonds should go down and then the yields should go up. So, you could see that approach, 4% or higher. All fiat currencies throughout history get into that same trap. You get to the point where you say, okay, we need to pump in liquidity to save the economy, but at the same time, we need to protect the dollar.
Right.
If you don't have that debt sitting on top of you, you can do that. But with the debt sitting there putting pressure on the dollar, it makes it difficult because you can't spend your way out. If you cut rates, inject liquidity, you're just injecting liquidity, you're printing dollars. So that means your debt goes higher. So that applies even more pressure to your dollar. So I don't see any possible way, if you look over the next 5 years, how the dollar doesn't take a really major correction where you're talking, the index down around even 70. And I've been using that number for a while. I just see a 30% or so correction in the dollar makes sense. I mean, we've sat here over the last year or so and watched our debt go from 26 or 27 trillion now to 33, and yet the price of gold's not higher.
Right.
So I look at that as a value play now. I mean, the higher the debt goes and gold doesn't move, gold becomes a better and better buy because that debt's just stacking up. I mean, we're not putting enough emphasis in the United States right now on mining. I looked at some of these numbers today. It's staggering. Right now, the United States is 100% dependent on imports for 12 of our critical minerals.
Yeah, it's insane.
50% dependent on another 31 minerals. Lithium demand, they expect, will double by 2030. Nickel demand will increase by 3 times by 2030. Copper demand will double by 2035. And just silver demand, just from solar panels alone, will increase by 700% by 2030.
Yeah.
So all these things, you're looking at these and you're saying, okay, clearly that's a sector that's going to explode in demand. The United States should be plowing money into this area, making it right now. If you want to go out and you want to build a refinery, for example, good luck. I mean, you got to go find a place that has an existing permitted refinery and then buy that. Because if you wanted to start your own refinery, it could take you 6 or 7 years just to get the permits.
There are lots of concerns about the direction of the United States and global economy in the coming months. One industry everyone is certain will take a big hit is the real estate industry. Average interest rate on a 30-year mortgage is now 7.75%, the highest since November 2000, and more than a whole percentage point above the 2008 highs. Mortgage rates have climbed by about 5% since 2020. For example, the payment on a $500,000 mortgage has increased by 80%, from $2,000 per month to $3,600 per month. Even if supply increases as the crisis gets more pronounced, affordability will get worse before it gets better. What are your thoughts on Parilla's interview? Do you agree that the economy is right on the edge of disaster and gold, silver, and other metals will benefit greatly from the collapse? Please share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.